I knew how to split them up, I could. But then I'd be talking to everybody, and they'd be looking this direction. I mean, I'm kind of used to that anyway, but it'd be worse. All right, actually a pretty good turnout for the Thursday before spring break. Even got my baseball players here, or one of them. Okay. All right, couple of things. First of all, if you did go to the career fair on Tuesday and you do have a business card, as you are leaving class today, if you would just be sure to put your name on the back of it. Please write it so I can read your name, and just place it up here. If you have any other extra point opportunities, or extra point items you've been to, for example, any other speaking engagements, club meetings, whatever, and also you'll have a really good opportunity April 3rd, 4th, 5th, and 6th, which is our Murray State's version of Money Smart Week. And so every afternoon that week, Monday, Tuesday, Wednesday, and Thursday, we're going to have financial literacy programs. Monday, Tuesday, and Thursday, they're going to be in Mason Hall Auditorium, which is the nursing building right across here. Wednesday is going to be in the Curris Center Ballroom. And we're going to talk about some pretty good topics. Tuesday, I'm speaking, and a banker is speaking on various bank-related items, credit scores. How do you get your credit score? What does it mean? That type of thing. How do you improve it? And we've got some pretty good giveaways. So you can get some extra points for that. Plus, you have the possibility to win things like they're giving away 2 $500 scholarships for undergraduates. So the more of those you attend, Monday through Thursday, the more chances you get your name in the hat to be drawn for a $500 scholarship. We're still in the process of buying things. In the past, I go use the Center for Banking and Finance money because it's a really important thing, so we try to get students there. I think we gave away an iPad mini. We've got some Beats wireless headphones. We had some Yeti tumblers. I don't know, some pretty decent stuff. So every day we try to give away a big item and then a bunch of smaller items. So you can learn something about finance, you can win something, and you can get some extra points. So again, that's April 3rd, 4th, 5th, and 6th. And you don't have to come to all of them, just the more you come to, better off it would be. Also, advising is the week that you get back from spring break, or it starts the week you get back from spring break. So let me put in another plug for our commercial bank management degree. If any of you are interested in that, come by and see me. I'll be happy to sit down and talk to you. Now, let me warn you that if you go to the Racer Audit program and you do a what-if analysis, you need to be sure to put in the 2016 catalog. The reason is the degree started in 2016, and so if you put, for example, if you put in a 2015 catalog, it's going to show you all the information except for the finance classes. It's going to cut off all the finance classes you have to take, and so you're going to look at your percentage of your degree completed, and you're going to get really excited because it's going to have about 15 or 20% additional that's not there, and that's because you've got 20 some odd hours of finance classes missing. So, but if you're interested in that, we're getting a lot of interest from employers about this. So again, it's, you may not have to take any additional time to complete your degree. If you're a finance student, it'd be a pretty simple move to go from finance to commercial bank management. And what that does for anybody who gets that degree, it sets you apart from the tens of thousands of other students who are graduating, whether it's with a business degree, whether it's with a specified finance degree, because there are not many commercial bank management options out there nationwide. So you would finish with you could finish with up to 21 hours of banking classes, which, that puts you ahead of, in terms of banking education, most universities in the United States. So again, it's a pretty good option. It's different, and if you're interested, come by and see me. We can sit down and discuss it pretty quickly. Okay, it will be painless. Even if you're still dealing with the Undergraduate Advising Center, you can come by and see me. Okay. All right. So, are there any questions about anything really to this point? Everybody looks so angry today. Why you look so angry? I just mentioned changing your major. That's all I did, okay? I did not insult you in any way whatsoever. They're just kind of frowning at me, kind of like, get this over with. We want to watch ball games. We want to start spring break, whatever it might be. All right. I'm even running people off. I mean, I really feel bad now. Anything on my face or something? I don't know what. I am really making people angry today. I'm sorry. Okay. Wow, that hurt. That could hurt my feelings if I was a sensitive person. That could really hurt my feelings. Nobody else leave, please. Okay, I may start tearing up here if anybody else leaves them. All right, we left off here. We were talking about risk and return, which is chapter 8. This is posted on Canvas. I checked it this morning. It is working, sounds fine. Everything's working like it's supposed to. Now remember, the first Canvas video is posted on, you go to the same place, but you have to go under additional items or something like that, and so to find the first video that I posted. All right, so we were talking here about how you can use diversification, which means assets moving in different directions to lower your risk, but keep your expected return the same. So I went through and I drew a really ugly picture of this on here, and we went through that example. And actually gave the baseball example of, all right, I feel better now. Somebody's come back. This is another example. This is in your in the book, and it just, again, shows you what can happen if you have assets that are negatively correlated or positively correlated. Now, the key here that this is trying to show you is simply, we've got three different potential stocks here, okay, or assets, X, Y, and Z. You'll notice X and Z, over the years, they move in the same direction. So when, they have the same returns each year. And if you take a look at the expected value of each stock, it's 12%. And if you take a look at the standard deviation, which is the level of risk, it is 3.16%. So this shows you here, what if we combine X and Z together? At least technically we can say, okay, we're splitting our money up. Instead of investing all in one stock, we're splitting it up into two stocks. So we're diversified, and we get the benefits from diversification. That's not actually true, because what you'll notice is, since these two stocks are perfectly positively correlated, they move in the same direction with the same strength. What that means is that even if you combine half and half, since they move together, you're not getting any benefits from diversification. Your expected value is still the same, and your risk level is still the same. On the other hand, if you have X and Y, you'll notice that as X is going up in value, or the percentage is increasing, Y is going down. And so if we did diversify here, put half our money in X, half of our money in Y, the expected value stays the same, which is good, but our risk level goes to 0. And that goes back to what we talked about on Tuesday, which was what we called an efficient portfolio. If you're putting together a portfolio of investments, why not put together the portfolio that provides you with the greatest amount of return for the least amount of risk? I mean, that just makes sense. Now, from that, we're going to take this risk and return idea, and we're going to look at something called the capital asset pricing model. And what this is it's actually a pretty simple model where you just give them the numbers and you plug it in, and we'll look at that a little bit later. But what this does is it puts a number with a level of risk. Because until this point, we've said if you take more risk, you expect a higher rate of return. You take less risk, you expect a lower rate of return. The problem is we haven't put a number with a risk level. And so that's what this allows us to put a number with a risk level. So It is, you need to know the definition, first of all, so you might want to put a mark by this. It says the capital asset pricing model is the basic theory or a model that links risk and return for all assets. So to simplify it a little bit, it measures how much additional risk or return an investor should expect from taking a little extra risk. So if we take a certain amount of risk, should we earn 10%, 12%, 14%, whatever it might be. Okay, so based on this capital asset pricing model, and again, this is a really big area of study in finance. And I will tell you that from the most technical point of view, the capital asset pricing model is a very theoretical concept. Okay, so it's a good starting point for understanding risk and return, but it's very theoretical. If you look at the actual model itself and really dig deep into it, there are lots of stipulations related to how the model works or how it can work. Now, let's look at 3 different definitions of risk, because this is going to be important when it comes to understanding this model. Again, as I said, finance is all about risk. So it says total risk here is the combination of a security's non-diversifiable risk and diversifiable risk. And so that's what we have here. Now, diversifiable risk, this is risk that can be completely eliminated with the proper portfolio of investments. So it says here, it says it can be eliminated through diversification. It is firm-specific risk. So things like a lawsuit. If you're invested in a company, for example, you invest in General Motors stock, and General Motors is hit with let's take that, but let's change this. You invest in Takata airbags, which Takata airbags are in millions and millions of passenger cars and trucks. And it is found that your airbags when they are employed, they shoot shards of metal out into the people that are supposed to be protected by the airbags, okay, which is an actual class action lawsuit right now. Well, you're going to face literally billions of dollars in lawsuits, and that can drive your company into bankruptcy. So if you put all of your money into Takata airbags and you have a class action lawsuit like this, you can lose everything that you've invested. That is a real world current day example. So lawsuits, labor strikes. A labor strike is an example of diversifiable risk because that can hurt the value of a company's stock. So anything that is firm specific is diversifiable risk. But again, the great thing is if we invest in enough stocks, we can eliminate that risk. Now, the other type of risk we're talking about here is what's called non-diversifiable risk. And it is a relevant portion of an asset's risk that can be attributed to market-specific factors that affect all firms. So things like a recession. An economic recession tends to affect almost all companies. It's going to hurt their stock price. A lot of times, something like a war will affect almost all firms within a certain economy. Now, the thing is, we can do away with diversifiable risk by investing in enough stocks, which leaves us with non-diversifiable risk to contend with. So when we say risk and return, what we're actually talking about is non-diversifiable risk and return, because we're assuming, or the capital asset pricing model assumes, that we have done away with all diversifiable risk. Now again, that's a big assumption because that's not true for all investors, but that's one of our major assumptions. So that's the key here. It's in italics at the bottom. The only relevant risk is non-diversifiable risk, or another way of saying it is systematic risk. So think of this as it's risk related to the entire economic system. So we're worried about non-diversifiable risk and return. So based on this, we can take a look at a graph. This graph is probably in every finance or corporate finance book ever written. And it shows us that we've got our total risk here, which is a combination of non-diversifiable and diversifiable risk. But what happens is we add stocks to our portfolio. So as we go from owning one stock to 5 different companies, to 10 different stocks, to 15, to 20, to 25. Now again, this is different companies, okay? These are not just shares of stock in one company. But what happens is we own more companies and we diversify the diversifiable risk. Essentially, now they leave it off of this horizontal line just to show you what's happening. But what's going to happen is we're going to do away with all diversifiable risk. These two lines are going to touch, which basically leaves us with non-diversifiable risk. And that's what we're having to contend with as investors. So that's what we're trying to minimize. Now, when we get to the capital asset pricing model, you're going to see something called a beta coefficient. And a lot of times when you first see this, let me jump ahead and then I'll come back to this. Okay, so this, we'll talk about this for just a minute and I'll go back to the beta coefficient. This is the capital asset pricing model. So don't worry about writing it down right now, I'll come back to it. But what it says is the return of a stock is equal to the risk-free rate plus the beta coefficient for that particular stock times the return of the market minus the risk-free rate. So every stock has what's called a beta coefficient. So let's go back to that, okay. It says here that the beta coefficient is a relative measure of non-diversifiable risk. Another way of saying it is it's an index of the degree of movement of an asset's return in response to a change in the market's return. So essentially what this tells us is the beta coefficient for a stock tells us how much does a stock's price move in response to a movement in the overall stock market. Does it move more than the overall market? Does it move less than the overall market? Does it move the same as the stock market? Now, we've got some issues here when it comes to this. For example, we're talking about a market's return, and actually we don't have a measure of the overall stock market. I mean, every stock available. We do have stock indexes such as the S&P 500, the Dow Jones Industrial Average, the NASDAQ. So we can take a look, we can choose one of those, for example, the S&P 500, and we can take a look on a daily basis. How much did the S&P 500 increase? Okay, to say it increased by 1%. How much did the price of Ford Motor Company increase? Did it increase by 1%? Did it increase by more than 1% or less than 1%? So as we take a look at this, and as we take a look at the concept of beta, now again, the market beta is always 1.0. And in doing this, if you take a look at the very bottom here, and I'm not going to go into this, but if you've taken a stat class, you have run something called a simple regression. And a simple regression simply means you're regressing one variable onto another variable. So think of this as an Excel spreadsheet. You've got one column of daily stock returns from, let's say, the S&P 500 for the last 3 years. You have another column with a certain stock's daily returns. So you've got this big, huge column of stock returns. You've got this big, huge column of market returns, and you simply run a simple regression. And what's going to happen is, and this takes all of 5 seconds to do, and what's going to happen is, among the output that you're going to receive, you're going to get something called the beta coefficient. So it's simply going to have a measure. It's going to be less than 1, equal to 1, or more than 1. Now, the market beta is always 1.0, and that's something that you need to know for the next test. And the reason is, if we regress the market's daily returns on the market's daily returns, you're going to get a beta of 1. Okay, it just has to work out that way. Now, as I said, each stock has a beta coefficient, and the way it works is, let's say we run a regression and we find that stock X has a beta of 1.4. Remember, the market beta is 1.0. So what this means is, if the market increases by 10%, then stock X would increase by 1.4 times 10%, or its price would be up by 14%. And that makes sense because stock X moves more than the market, it's riskier than the market, so when the market is up, stock X is going to be up by a larger percentage than the market. It works the other way also. If the market is down by 10%, stock X is expected to decrease by 1.4 times 10, or a negative 14%. So high beta stocks, a lot of risk, a lot of potential return, feelings are hurt again. Okay. A lot of potential return, but also you can lose a lot of money also. So again, it goes back to that risk versus return trade-off that we've talked about throughout the semester. Now, this is actually a pretty good, just a little study guide for betas and what they mean. And so as you're preparing for the test, the Thursday after spring break, you can see, for example, if a stock has a beta of 2.0, is twice as responsive as the market. A beta of 1 is equal to the market. And a beta of 0.5 means it's only half as responsive as the market. And then occasionally, not very often, but occasionally, you will have stocks with negative betas. That means they move in the opposite direction of the market, or they are negatively correlated with the stock market. And you just don't find that very often, okay? Now, based on this, I just pulled, you'll notice the date on these. It's kind of an unusual date, June 7th, 2010. And you may be thinking, well, why don't you update that table? Okay, it's 2017. You need to update that. Well, I leave that table up there for a reason, because this was a very, very strange time in our economy. Now, what you see there, you see some companies that most of you have heard of. Okay, Amazon, General Electric, Procter & Gamble, Citigroup, Carnival, Ford, Apple, Monster Beverage, and Netflix. I'm sure all of you have heard of all of those companies. Typically, the way it works is large companies that have been around for a long time, that are very stable, such as Ford Motor Company or Citi, is the parent company of Citibank, they tend to have fairly low betas. They tend to have betas right at approximately the market beta, which is right around 1. But take a look at Ford's beta, take a look at Citibank's beta. They're extremely high. I mean, you won't see this again probably in your lifetime. So we've got Citibank with a beta of 2.6. What was happening in 2010 in our economy regarding banks? What? They were failing. The government was stepping in to bail them out. There was a ton of risk involved in terms of are these banks actually going to make it? How much is the government going to have to invest to prop up the big banks? If you were a small bank, the government didn't really care about you. You could go ahead and fail. We had over 500 bank failures from 2008 to 2015, 16. So it was a very risky time for banks. And that is shown by Citibank's beta coefficient. Now, if we take a look at it today, what you're going to see is it's actually been going back up some, but that's because the stock price has been going back up since the election. Okay, it's been a really good time for banks since the presidential election. If you look at Ford Motor Company, Ford's been around forever, and it's typically a very stable stock. But what was happening with gas prices in 2010? That's when we were seeing $3, $3.50. People were predicting $5 a gallon gasoline. And Ford Motor Company, I mean, they make a lot of different cars and trucks, but they specialize in trucks that don't get very good gas mileage and cars that maybe don't get very good gas mileage compared to other cars. And so people were looking at Ford and thinking, wow, we don't even know if Ford's going to be able to make it because gas is going to get so expensive. We're going to have to go to all electric cars. And GM was bailed out by the government. Ford did not take the bailout, but they were close to failure. And so it was a really risky time for car companies in the United States. Now, what happened was gas prices went down. People forgot about this because if gas is around $2 per gallon, people are going to buy their big cars and trucks. That's just how it is, okay? And the United States is different from most other countries in the world because if you go to other countries, you're going to see a lot of very, very small cars and trucks. It's very unusual to see a full-size truck in Europe. You see a lot of trucks, but they're small, okay? And the reason is it's so expensive to run cars and trucks in other countries. So the United States is somewhat different from the rest of the world. Now, if you take a look at some companies such as let's see, Carnival Cruise Line, beta of 1.4. Typically, the way this works, and again, maybe this will help explain what this beta is telling you. Luxury items tend to have higher betas than or staples. Because what happens is, if the economy's doing really well, and just you're working overtime, you've got plenty of cash on hand, you tend to purchase luxury items. So you may go on a cruise, you may purchase an expensive car, or you'll do whatever is considered in the luxury category. But if we're in a recession, if the economy is doing terrible, you're trying to put food on the table, you're trying to pay the rent, you're trying to keep the electric bill paid each month, then you're probably not going to take a cruise. Okay? So this is also a little bit unusual, because I would expect Carnival Cruise Line to have a higher beta than some of the other companies up here. Now, there are, you look at Monster Beverage, a beta of 0.4. I mean, this is really, really odd. Netflix, 0.6. So what this tells me is, at least to this point, it's probably going to be, it'll be higher now, but that's because Netflix stock has increased in price. But what this tells me is, no matter what's happening in the economy, since Netflix is considered fairly cheap, and it's also, I mean, in 2010 it might not have been, but now almost everybody has Netflix. You pay your $8.99 a month, and you don't really worry about it, and it's just part of your life, just like having electricity almost. So it's almost become just a permanent part of our society, in terms of we just pay our monthly Netflix bill and watch our movies and television shows. Amazon, 0.9 beta. That means people are going to use Amazon whether the market's up, whether the market's down. Okay, and it's only become more popular since 2010. Now, there are some types of companies, such as utility companies. That would be a water company, an electric company, a natural gas company. Utility companies tend betas of 0.3, 0.4, 0.5. I mean, a couple of things. One is, it means they're not very exciting investments. But for a lot of investors, that's what they want. They don't want an exciting investment. They want something that's going to be nice. For example, of 0.4, that market 5%. That's not down 10%, expected to drop only by 4%. So you don't have as much upside, but you don't have as much downside also when it comes to stocks with low betas. And an example of utilities, it makes perfect sense, because no matter what's happening in the economy, for example, if, let's say that yesterday I received a 20% pay rate. So things are going well, okay? I'm making more money. So today, I get up, I get ready, I start to go to work, I'm walking out the door, I turn my lights off, just like I do every day, and then I think, you know what? I just got a 20% pay raise yesterday. I can afford to leave my lights on today while I go to work. Is that how we think? No, you're going to turn your lights off. You're not going to use more or less electricity because you got a pay raise. Are you going to take more showers every day because you got a pay raise? No. If you take 1 or 2 showers per day, you're going to continue to take 1 or 2 showers per day. So utility companies, there's not a lot of difference in demand based on what the economy is doing. Those are considered necessities. Now, when we take a look at betas, this is how to calculate a portfolio beta. You need to know this. This formula will be given to you on the next exam. But again, this is just a weighted average. So this simply takes the beta of every stock in a portfolio and multiplies it by the percentage weight of that stock. So this is what we did when we were calculating a portfolio return on Tuesday. So it's simply the percentage weight of stock 1 times the beta of stock 1 plus the percentage weight of stock 2 times the beta of stock 2. And you just do this for as many stocks as you have in your portfolio. So if you have 3 stocks, you multiply it 3 times. Add them together. And on the next slide, there should be an example of this. Okay, so we've got a couple of different portfolios here. Um, we'll just focus on, we can look at portfolio V, for example. It has 5 stocks. You can see that stock 1 makes up 10% of the portfolio, stock 2 makes up 30%, and so on. And then you've got the beta for each stock. So if we multiply the weight, they call it a proportion, but it's the percentage weight, times the beta for each one, and then add them together, what we're going to come up with is something that looks like this. So this was our stock V, so the 10% times the beta of stock 1 plus the 30% weight of stock 2 times the beta of stock 2, and we just keep doing that. And we find that portfolio V has a beta of 1.2. Portfolio W has a beta of 0.91. So if we're looking at these two, we would say that portfolio W is less risky than portfolio V because it has a lower overall beta. So you need to be able to do this. You'll see a question about this on the next test. It's pretty straightforward, pretty simple. Now, based on that, we can actually take a look at the capital asset pricing model. Okay, so I went through this earlier, and again, this is just the return of a stock, and that's any stock, is equal to the risk-free rate. Now, the risk-free rate is the most basic rate of return that we could earn as an investor. So it's the rate that we expect, basically no risk on our investment. Now, we don't really know the true risk-free rate of return, but what we do know is the return on a very almost risk-free investment, such as a United States Treasury bill. So we can use this as a substitute for the risk-free rate. We add that to the beta coefficient for the stock, which we've talked about that, so it'll be less than 1, 1, more than 1, 2, whatever it might be, multiplied by the return of the market. Now again, we don't know what the market portfolio return is for all stocks, so we use something like the S&P 500 index minus the risk-free rate. Now we've got a couple of things going on here in our model. If we take the return of the market minus the risk-free rate, this is the additional premium or the additional return that we expect to earn going from a riskless security to the basic stock market return. So we expect to earn a premium because we're taking more risk, and that makes sense. If we take that market risk premium and multiply it by an individual stock's beta coefficient, then that is the individual stock's risk premium. So for example, let's say that the market return is 10%, the risk-free rate is 4%. So 10 minus 4 is 6%. We expect to earn a 6% premium by going from no risk to the average stock in the market. But if we go from no risk to the average stock, and then we want to invest in a stock that has a beta of, let's say, 1.5, which means it's 1.5 times as risky as the market, then that would be our 10 minus 4, which is our 6% multiplied by 1.5, means we expect now a 9% premium for investing in that particular stock. So what this does is, like I mentioned earlier, it tells us what percentage can we expect to earn for taking a certain amount of risk, which we haven't talked about so far. So this was actually a pretty big breakthrough when it was discovered. Now you can look at this right now and you can say, well, you know, I probably could have come up with this, but at the time, this was a pretty big deal in the finance area. All right, so here's an example to show you how easy it is to work with the capital asset pricing model. You'll be given the model, by the way, the formula. And we've got a company, Benjamin Corporation, a growing computer developer, wishes to determine the required return on asset Z, which has a beta of 1.5. The risk-free rate of return is 7. The return on the market is 11. So we have everything we need. The beta, the risk-free rate, and the market rate of return. So we just plug it in. So following this formula, okay, the return for asset Z is equal to the risk-free rate of 7 plus the stock's beta of 1.5 times the return of the market of 11 minus the risk-free rate of 7. Now, when you're doing this, it's really important to follow the order of calculations here. So we're going to take the 11 minus 7 first, which is 4%, multiplied by 1.5, which is 6, and then add to that 7%. So we would expect to earn a total of 13% on this particular stock. That pretty simple? Pretty straightforward? I mean, again, you're given all this information, you just plug it in and do the calculation. All right, now based on the capital asset pricing model, we can actually graph this and come up with something called a security market line. So the security market line is just a graph of the capital asset pricing model. But it's going to tell us a couple of things, which I'll get to in just a minute. But when we, and I'm not going to ask you to graph this on the test, okay? I just want you to understand what is the security market line. But the security market line basically tells us how much risk is in the market and how risk averse are investors, because investors change their degree of risk aversion almost daily. There are things that occur in the market or occur in our lives that cause us to be more or less risk averse. For example, if you're sitting there on your phones and a news report comes out that a plane has flown into a building in Chicago, automatically, what do you think? Was it an accident? You think terrorist attack. Okay, this is what we do. And when that happens, investors become very risk averse. They get scared. They want to move their money somewhere safe until they can figure out what happened. They're going to start moving their money out of stocks into safer investments, into cash or cash-like products. So the market is going to drop, and it's going to drop really fast until it occurs and they figure out what happens. And let's say it would just happen. I mean, in history, there have been pilots who have just flown into buildings. They didn't mean to. They just flew into a building. Okay? So let's say it was determined it was an accident. The market's going to go back up. So we become more risk averse based on very presidential elections causes that. Hell, the NCAA tournament might cause that, okay? I mean, depending on what's happening. I mean, it's just really odd the way investors think. Investors overreact and investors underreact, but it causes the security market line, which looks like this, to change in slope. The steeper the slope, the more risk averse. The flatter the slope, the less risk averse. Now, this is a graph using the numbers from our previous example. So when we were here, okay? So the risk-free rate of 7, the return to the market of 11, the beta of 1.5. So that's what we have here. We've got a required return, and notice this is our risk-free rate of 7%, this is our origin, and then we've got our level of non-diversifiable risk, which is measured by the beta. So we've got a beta of 0, where we have no risk. We've got a beta of 0.5, a beta of 1, a beta of 1.5, beta of 2. So if we graph the information that we just calculated, we found out that with a beta of 1.5, that stock had an expected return of 13%. We need 2 points for our line, so we've got our origin and we've got our return that we just calculated. Now, in looking at this, let's say we didn't want to go through this calculation and come up with a 13% return. What do we know about the capital asset pricing model, the beta coefficient, and the information that we're given here that allows us to come up with a second point for our line, even if we don't go through this calculation? And I'll go back to the graph. We've got one piece of information given to us that helps us with our second point for this line. We were given the market return. The market return we said was 11%. And we also know that the market beta is always what? 1.0, okay? So if you're given the market return and you know the market beta is always 1, then we have our beta coefficient here, and we can simply go up to 11%. This will provide us with our second point, and we wouldn't even have to go through this calculation to come up with the security market line. Now, based on this and based on our what's happening with the security market line, because again, you don't really see this. This is more theory of what's happening in the economy. But it does help to explain why investors become more or less risk averse almost on a daily basis. So if we take a look at a couple of things that can cause the security market line to shift or to change its slope, they're listed here. One is a change in expected inflation. The other is a change in the degree of risk aversion. Now, again, I'm not going to ask you to draw any security market lines, but I want you to just to understand what happens, and this is what happens when we have an increase in expected inflation. Now, somebody give me a very simple definition of inflation. Okay, that's all it is. Price is going up. That's inflation. So if we expect inflation to increase over the next year or 2 years or 3 years, what happens is, as investors, we build that into our expected return. Because we want a return on our investments, but if we have inflation, that simply eats away at the money that we're earning, so we're not a lot better off, so we have to build that into our expected return. So in this case, let's say that we start here. These are the numbers that we started with earlier, okay, our 7% risk-free rate, our expected return of 13% with a beta of 1.5, and let's say that we expect inflation to increase by 3% or 300 basis points. What's going to happen is it is going to cause a parallel shift up of the security market line. So we're going to go from our green line here to this orange line. Notice every expected rate of return increases by 3 percentage points. So we go from a risk-free rate of 7 to a risk-free rate of 10%. At a beta of 1.5, we don't expect to earn 13% any longer. We expect to earn 16%. Now, the question is, in the green box here, are you any better off because you are now earning 3 percentage points more on your investments? Okay, see some of you shaking your head, no, why not? Okay, that's exactly right. If prices go up by 3 percentage points and your return goes up by 3 percentage points, you're no better off, but also you're no worse off. Okay, everything's basically the same. So you need to know that expected inflation causes a parallel shift up or down of the security market line and all corresponding rates of return. So that's the first item. The second possibility is a change in risk aversion for investors. Now again, let me remind you, if you're risk averse, that doesn't mean you don't like risk. What it means is you want to be paid for taking more risk. So in this case, if investors become more risk averse, so again, we'll start here with our original security market line, so our green line here. And it tells us here, the slope of the security market line reflects the extent to which investors are averse to risk. An increase in risk aversion increases the slope of the security market line, which results in higher required returns at each level of risk. So let's say we're here, we're operating on the green line, and something happens that scares us. Whether it's a terrorist attack, whether it's an election, whether it's whatever it might be. And what happens is we shift our security market line to a steeper slope, even though we don't really realize we're doing it. But what that says is if we're more risk averse, previously at a risk level of 1.5, we were happy with a 13% return. We were fine with that. But now at the same level of risk, because we're now more risk averse, we're going to require a 17.5% rate of return for taking the same amount of risk that we did yesterday or last week. Now, notice that the origin doesn't change. It's still 7%. And why is it still 7%? It's not really having to do with prices. It has to do with, remember, for risk aversion to be a factor, you have to have what? You have to have risk. And here, with the beta of 0, how much risk do we have? There's no risk. So with no risk involved, the rate of return doesn't change. But you'll notice as we move to the right on this graph, to the right when we enter risky territory, even taking a slight amount of risk means we require a higher rate of return. And as the risk increases, you'll notice the rate of return now increasing. So again, the degree of risk aversion, as it becomes steeper, we want a higher return. As it becomes flatter, we take a lower return. Okay? All right, so this just basically tells you that the capital asset pricing model is not perfect. I mean, it's a pretty good start for understanding risk and return. It assumes that our markets are perfectly efficient, which again is a pretty big assumption to make. But it's a good teaching tool to help us understand what that is. And finally, that is Chapter 8. Risk and return the week before spring break. That's probably never been done before, okay? Never been attempted. Everybody was scared to try that before. All right, so questions. Now remember, the Tuesday after spring break, we're going to talk about your test. We're going to review for the test over Chapter 5 and Chapter 8. The Thursday after spring break will be your second test covering Chapter 5 and Chapter 8. So, if there are no questions, have a great break. Have a safe break. I will see you back here week after next.